So today's session, we would be talking about the accounting principles. We will discuss what are accounting principles and we will discuss that in detail. On that note, accounting principles are rules and guidelines that are given to companies to ensure there is a uniformity with which they would go about processing the financial data. The reason why we would have rules and regulations which would be prescribed by the regulatory bodies or by the government is so that the practices across the country or across the place would be uniform. So, for example, if you have to ride or if you have to drive, you must know the driving rules. Okay, so there are certain driving rules that you must follow. Before you turn, you have to make sure that you input on the indicator. In some cases, you may have to show your hand signals. While riding, you have to make sure that you always stick to the left side of the road. Now, the reason why we have these rules and guidelines in place is to ensure that there's a uniformity in that practice. Wherever we go, or whichever part of India that you go, everyone follows the same guideline. Now, with respect to COVID, from time to time, the government keeps giving a lot of guidelines. The government keeps giving what is called as SOP, or standard operating procedures. If you must not have more than 50% of your capacity people coming in, you must ensure that there's a thermal check done. You must ensure sanitizers are placed. You have to keep a record of the people who are visiting. Now, why is all this being enforced? This has been enforced so that the certain objective is achieved. A certain objective is achieved. So likewise, from a business's point of view, we have accounting principles so that wherever we go, the accounting practices are uniform, the accounting procedures would remain the same. Now, the accounting principles are usually issued by a body which is called as Financial Accounting Standards Board, which stands for FASB. Now, when the accounting principles are prescribed by or they are enforced by a regulatory body, those accounting principles are called as generally accepted accounting principles. I'll repeat that. When the accounting principles are enforced by a regulatory body, it is referred to as generally accepted accounting principles, or GAAP in short. Now let's look at what are generally accepted accounting principles in detail. They are a common set of principles and standards which are given. We already saw that if you don't have uniform set of principles, if you don't have uniform set of procedures or guidelines, it could so happen that everyone would go about carrying out accounting the way they would feel like. In order to overcome this problem, in order to ensure that the accounting procedures, how books of accounts are maintained across the firms, remains standard, remains the same. That's the reason why we have generally accepted accounting principles. Now, what you have to remember is it is mandatory for organizations or companies to follow them while preparing their books of accounts. Okay? So companies, organizations, they will have to follow the generally accepted accounting principles while preparing their books of accounts. Now, in India, accounting principles, the GAAP, it is referred to as Indian Accounting Standards. In short, it is referred to as IND-AS. In short, it is called as IND-AS. Now, in India, IND-AS gets issued by a board which is called as Accounting Standards Board of India, it is a board which is under the Institute of Chartered Accountants of India. So it is this very same body that is responsible for certifying chartered accountants. Now, generally accepted accounting principles, it can be broadly classified into two. You have accounting concepts and then you have accounting conventions. Accounting principles can be broadly classified into two. You have accounting concepts and then you have accounting conventions. Now we'll look at accounting concepts and accounting conventions in detail. What the key takeaway that you have to remember is they are a common set of principles, standards that are given so that all the companies would go about uniformly following their procedures and practices when it comes to the maintenance of books of accounts and preparation of final accounts. Accounting principles can be broadly classified into two. You have accounting concepts and then you have accounting conventions. Now let's look at what are accounting concepts. Accounting concepts are a set of assumptions that are given to the accountant to prepare books of accounts. Okay? They are a set of, it is called as the fundamental assumptions. Okay? They are a set of basic assumptions that are given to the accountant so that the accountant can go about preparing the books of accounts. Now here, the books of accounts, namely journals and ledgers, they are maintained based on these assumptions. Okay? Your books of accounts, namely your journals and your ledgers, these are maintained based on your accounting concepts. Now let's look at accounting concepts in detail. The first concept that we would be learning is business entity concept. The first concept that we would be learning is business entity concept. What is meant by business entity concept? Business entity concept refers to it states that the affairs of the business and the affairs of the proprietor, they are independent. Okay? The affairs of the business and the affairs of the proprietor, they are independent. Previously, we learned the concept of drawings in capital. We saw drawings is the money taken by the proprietor for his personal use. Capital is the money that is contributed by the proprietor for starting the business. Now, they are considered as, when the proprietor takes money out for his personal use, there is a differentiation between business's money and the proprietor's money. There is a difference between the business's need and the proprietor's personal need. The reason why we are able to enforce this is because of business entity concept. It clearly states that the affairs of the proprietor are independent from the affairs of the business. Next is money measurement concept. Money measurement concept tells you that only transactions that can be quantified in terms of money would be recorded into your books of accounts. Transactions that can be quantified, transactions that can be measured in terms of money, these are the ones which are recorded into your books of accounts. Then you have cost concept. Cost concept tells you that purchase of assets are recorded at the actual price. So let's think about an example. Imagine I decide to buy furniture worth 1 lakh into my business. Now, I picked up the furniture. The total cost came up to 1 lakh. But at the time that I went to the cash counter to pay the money, I realized that the business belongs to a close friend of mine. So because we were acquaintances, we were friends, the proprietor decided to give me a discount of, let's say, 10,000 rupees. So I picked up furniture worth 1,10,000, but now I'm only paying 1 lakh. So according to cost concept, the assets that I'm keeping in my books of accounts, the assets that I've just bought for my business, I would be recording at the actual cost. The cost was 1,10,000. However, I have paid only 1 lakh, which means in my books of accounts, when I record the money spent, that I've spent for purchasing furniture, I would be recording only 1 lakh, not 1,10,000. This is because that is the actual amount of money that I have spent. Moving on, the next concept tells us that the next concept that we would be learning is the going concern concept. Now, the going concern concept assumes that the business will have perpetual existence, okay? Which means the business is likely to exist forever. Once the business starts, unless and until there are some serious reasons, it would not close itself down. This is very important because when it comes to factoring for concepts such as depreciation, you may have bought some fixed assets into your firm, you may have to account for depreciation for 15 years, 20 years. So unless and until you have a vision, or unless until you have an assumption that the business is likely to be there for 20 years, how can you charge the depreciation for 20 years? So going concern concepts assumes that the business is likely to exist forever. So that's the reason why it will continue its operation for an indefinite period of time. The reason why we have this statement is because if you have to incorporate the treatment of certain accounting practices, if you have to bring in the treatment of certain accounting concepts, it is mandatory for you to ensure that your business has a perpetual existence. The next concept that we would be studying is the dual aspect concept. Dual aspect concept tells us that every transaction has got two effects and both the effects have to be accounted for. Every transaction has got two effects and both the effects must be accounted for. So any transaction that you pick up, it always has got two effects. So let's think of an example. Buying furniture for cash. So you went to the shop, you bought furniture, you paid money. Now there are two effects. The first effect is you're paying money, cash is going out from your firm. Second effect is that you're receiving some furniture. Or let's think of another example. You decide to sell your car. Okay. So transaction was selling the car. That transaction has got now two effects. The first effect is that you no longer have a car with you. Second effect is that the value of the car, the corresponding amount of cash you receiving. So one transaction, two effects. So dual aspect concept tells you that every transaction has got two effects and both the effects must be accounted for. Next is realization concept. This is also called as revenue realization concept. Revenue realization concept tells you that you should account for revenue only when it is realized or only when you're receiving the revenue. Okay? So accounting should be realized only when you're receiving the money. So here's the deal. Imagine I decide to take tuition maybe for one of you. But it so happened that you're paying the money after 2 years. So I've given you the service right now, but the revenue for the service that I've rendered to you, I'm receiving it after 2 years. So according to revenue realization concept, I should be recording the revenue only when I'm realizing that. The next concept that we would be learning is the accrual concept. Now, what accrual concept means that you should recognize expenses only when it is time for you to make the payment. Okay? You should recognize your expenses, or you should account for your expenses. You should show your expense into your books of accounts only when it is time for you to make the payment, or only when it becomes due for you to make the payment. So here's the deal. Let's say you bought some raw material. You bought some raw material. The person who supplied you the raw material, he is your best friend, and then he told you, it's not a problem, you take your time, you can pay me after 1 month. Okay? So you got the product right now, but you're making the payment only after 1 month. So according to accrual concept, that expense should be shown into your books of accounts only when you're making the actual payment. Okay? So it should be recognized only when you're actually making the payment. So until such time, you can show that as a credit. Okay? Until such time, you can show that as a credit. So credit, when you show that as a credit, you're making a note, you're acknowledging the fact that there's a certain amount of money that you have to pay. But you would show that as an actual expense only when you have made the payment. Okay? So according to accrual concept, expenses should be recognized only when it becomes due for your payment. Okay? So that's what is meant by the accrual concept. The next concept that we would be learning is the accounting period concept. Accounting period concept states that financial statements should be prepared for every period that is at the end of the financial year. So what it explains is that in your business, you must follow a fixed accounting period. You must have a fixed financial year. Now, in India, according to the government, financial year is from 1st of April until 31st March. Okay, so our financial year would start from 1st of April and then it would conclude on 31st of March in the following year. So this is considered as a financial year in India. So which means on 1st of April, it is like a happy new year for you from your books of accounts and financial statements perspective. Okay, at the end of the year, at the end of the financial year, that is on 31st March to 31st March of the preceding year or of the next year, what would happen is you would close your books of accounts and then you would prepare your final accounts for that period of time. So that is considered as a financial year in India. So likewise, every country would have their own financial year. Okay, every country would have their own financial year. So they are expected to follow that financial year. Accounting period concept tells us that you have to maintain your books of accounts for a fixed period, which is your financial year, and then at the end of the financial year, you have to go about preparing your books of accounts. This is also the reason why after 31st March, most of the companies, most of the businesses, they would close all their books of accounts. They would call in a chartered accountant. The chartered accountant will come, they will cross-examine the books of accounts, they will do an auditing procedure, and the chartered accountant would certify the final accounts and then give it to the proprietor or give it to the owner of the business. This is because they have followed an accounting period, and then at the end of the accounting period, they're trying to bring an affirmation, they're trying to bring a confirmation stating that what they have done across the last 1 year, it is according to the law, it is according to the defined system. So that is what is meant by accounting period concept. The last concept that we would be learning is the matching concept. Matching concept states that the revenues of a period should be matched with the corresponding expenses. What does that mean? Okay. If you're looking at evaluating expenses for, let's say, for the month of September, then you should correspond that with the revenue for the month of September. Okay. If you're taking, let's say, financial year 31st March 2020 if you're taking the financial year of 1st April 2020 until 31st March 2021, then you're expected to match for that accounting period. You cannot take income for 2020-21 and then expenses for 2019-20. Why? Because you're trying to match the expenses of one time frame with the income of another time frame. Or you should not try and match the income of January with the expenses of February. That would not be fair. That would not be apt. That would not be correct, or that would not be accurate. So matching concept states that your revenue for a period should be matched with the corresponding expenses of the same period. That is what is meant by matching concept. The next part of the session, we would be learning accounting conventions. We've learned accounting concepts. Now we would be learning accounting conventions. Now, what are accounting conventions? Conventions are methods or procedures which have a universal acceptance. In other words, accounting conventions are best practices. Okay? They are methods, they are procedures which are given to the accountant. Now, accounting conventions are given to an accountant so that he could go about preparing the final accounts of a firm. Okay? So, accounting conventions are given to the accountant in order to help him to prepare the final accounts. Accounting concepts are assumptions. Accounting conventions are best practices. Accounting concepts are given for preparation of books of accounts. Accounting conventions are given for the preparation of final statement. Now let's look at accounting conventions in detail. Now there are 4 accounting conventions that we have to learn. The first one is the convention of consistency. Okay. The first method is the convention of consistency. Convention of consistency states that accounting statements can be compared only when accounting policies are followed consistently by the firm over a period of time. However, changes should be made only in special circumstances. What this means is, if you have adopted certain methods or practices when it comes to preparation of your books of accounts and your final statements, you have to follow that uniformly. So, for example, imagine you bought machinery into your firm. You decide to charge depreciation on the machinery. The first year, you decide to follow the annuity method. Second year, on the same machinery, you decide to charge depreciation according to written down value method. Third year, you again decide to go back to annuity method. Fourth year, you again followed annuity method. Fifth year, you decide to go back to written down method. Okay, so you're not having a consistency when it comes to charging depreciation on the same asset over a period of time. Now, this is a violation. So, what convention of consistency states that when you have adopted a certain practice, when it comes to preparation of your final statements, you have to follow that uniformly. Okay. Now, you should think of changing your practices only if there is a special circumstance. That is when you have to think of changing your practices. So, convention of consistency states that you should consistently follow an accounting policy of preparing your final statements. Next convention that we would be learning is the convention of full disclosure, or it's called as convention of full disclosure. Convention of full disclosure states that the financial statements should be prepared in such a way that it discloses all material information to the user to help them to take a rational decision. In other words, when the accountant prepares the final accounts or the final statements of a firm, they should not hide any transaction. Okay? They should not go about carrying any malpractice where they try and cover up or they try and do some kind of a window dressing to cover up or to hide certain transactions. So that should not be done. Convention of full disclosure states that while preparing the final accounts, final statements of a firm, the accountant has to disclose for all the transactions. That is what is meant by convention of full disclosure. Next, we have convention of materiality. Okay. Next is convention of materiality. Convention of materiality states that only items which have significant economic effect should be disclosed into your final accounts. Now, you may have a feeling that this is in violation of convention of full disclosure. You may have a feeling that this is in violation of convention of full disclosure. This does not violate the convention of full disclosure. So here's the deal. Imagine in your firm, you went about buy some stationery. You bought pencil, you bought eraser, you bought some color pen, you bought some glue, etc. So there were a lot of stationery that you bought. Now, while preparing your final accounts, remember you have convention of full disclosure. Convention of full disclosure states that all the transactions that you have carried out, it has to be shown. So instead of showing into your final accounts as a pen, pencil, eraser, sharpener, you can compress all this and you can show that as stationery. So stationery would make more sense. Instead of making your final statement look very exhaustive in nature, you can make it look rather simple by disclosing all the items as stationery. When you do so, you're not violating your convention of full disclosure. At the same time, you're ensuring that only relevant items are being disclosed in your final accounts. So that is what is meant by convention of materiality. So convention of materiality states that only items that has got significant economic effect should be disclosed into your books of accounts. Next is convention of conservatism. Convention of conservatism. Convention of conservatism states that a firm should not anticipate incomes and gains but provide for all expenses and losses. Okay, convention of conservatism states that accountants should not anticipate incomes and gains, but they should provide for all expenses and losses. So what does this mean? Imagine you're an accountant in a big firm. Okay? This financial year, you have made a profit of only 1 lakh. Okay? Your boss called you to his cabin, and then he's having a conversation with you, and he's asking you, how much do you think is a profit this time? Okay? You know very well that you're likely to make, or you have made only a profit of 1 lakh. But just to get into your manager's books, your boss's good books, you said, manager, we are doing very well. We have made a profit of 20 lakhs. But what is your actual books of accounts telling you? Your books of accounts is telling you that you've made a profit of only 1 lakh. But what are you telling your manager? What were you telling your boss? We have made a profit of 20 lakhs. Okay. So what have you done? You're anticipating excess gain. You're anticipating excess profit. Okay. Likewise, you should do the same when it comes to expenses as well. You should not try and hide in expenses. So let's say your firm, your firm decide to buy some machinery. Okay, you know very well there's a transportation cost, there's an installation cost, there is a maintenance cost which is involved. Okay, but you try and hide all that and you say, "Don't worry, boss, we just have to pay for the price of the machinery." So what have you done? You have violated convention of conservatism. So a convention of conservatism states that you should you should not anticipate any incomes or gains, but you should provide for all expenses and losses. So these were the accounting